Good morning, guys. Welcome to Mug Briefing. If you buy a Coke at a grocery store or grab a Sprite at a ball game, you probably don't think about data systems or digital strategy. But this week, that's exactly what the Coca-Cola Company was talking about. At an investor conference in New York called the Consumer Analyst Group of New York, known as CAGNY, Coca-Cola laid out how it plans to grow in 2026. This was not a quarterly earnings report. It was a strategic presentation to investors on February 17, 2026. In the last 24 hours, financial outlets republished transcripts and summaries of that presentation, bringing the company's message back into the spotlight. So, what actually happened? Coca-Cola did not announce a wave of brand new sodas or launch a surprise product. Instead, executives outlined a growth framework for 2026 built around four themes: being more consumer-centric, accelerating innovation, strengthening alignment with bottlers, and building what management called a digital superpower. The presentation was led by Henrique Braun, who is currently Chief Operating Officer and is scheduled to become CEO on March 31, 2026. CFO John Murphy discussed the company's financial framework, and Coca-Cola confirmed that Sedef's Salingan Sahin will assume the newly created role of Chief Digital Officer on March 31, 2026, the same day Braun becomes CEO. That timing matters. The leadership transition has been announced, but it has not yet taken effect. The strategy is being positioned as the roadmap for the next chapter under new leadership. During the CAGNY presentation, management referenced growth targets that investor coverage summarized as roughly 7 to 8% earnings per share growth. Those figures reflect the company's framing to investors, as reported in transcripts and summaries. This was not a sudden change to guidance announced in an emergency filing. It was a reiteration of the company's financial ambitions within a broader strategy discussion. Now about this idea of a digital superpower. Coca-Cola has talked about digital transformation before. This is not the first time the company has emphasized data, marketing technology, and analytics. What's new is the clearer structure and executive focus. Creating a dedicated Chief Digital Officer role signals that digital systems are being elevated to the same level as finance or operations in the leadership hierarchy. But the company did not publish a detailed line-item budget for digital investments during the presentation. It did not announce a single named app overhaul or a specific tech acquisition. The language focused on integration, using data more effectively across marketing, innovation, and bottler coordination. That distinction is important. Digital integration is a tool. It is not a product by itself. Management framed it as a way to launch products faster, target promotions more precisely, and expand margins over time. Margin expansion means keeping more profit from each dollar of revenue. That is a goal, not a guarantee. So why is this happening now? Part of the answer likely relates to leadership timing. When a new CEO is about to take over, investors want clarity. Outlining a 2026 framework before March 31st gives the market a sense of continuity and direction. Another factor is the competitive environment. Beverage companies face changing consumer preferences, price sensitivity, and global growth variability. Using data to adjust marketing and innovation more quickly can help stabilize performance in uneven markets. It is also reasonable to interpret this as responding to investor expectations. Public companies are under constant pressure to show how they will grow earnings. A clear digital narrative can reassure analysts that the company is not standing still. Who benefits? Investors benefit from clearer targets and leadership timing. Bottlers, the independent companies that bottle and distribute Coca-Cola products, may benefit from tighter coordination if digital systems improve demand forecasting and marketing alignment. But stronger alignment can also require system upgrades and operational adjustments on their side. Consumers may see more targeted promotions, new packaging experiments, or localized product launches in 2026, but they are unlikely to wake up tomorrow and see dramatic changes on store shelves simply because a chief digital officer was named. Employees could see internal shifts in reporting lines or project priorities as digital integration becomes more central. However, the presentation did not announce layoffs or restructuring tied to this strategy. What does this change? For everyday shoppers, the changes will likely be subtle. Marketing could become more personalized, innovation cycles could move faster, loyalty programs or digital engagement efforts could expand. But Coca-Cola is not becoming a tech company. It remains a beverage company using technology to sharpen its operations. For investors, the key question is execution. A 7 to 8% earnings per share growth target reflects ambition. Whether it is achieved will depend on sales performance, pricing power, cost control, and operational efficiency, including whether digital initiatives actually improve margins. For bottlers, closer digital alignment may mean system investments or process upgrades. That could increase short-term operational demands, even if it improves long-term coordination. What could happen next? Analysts are likely to adjust earnings models in the coming weeks, based on the CAGNY presentation. Future earnings calls may include more references to digital metrics if management wants to demonstrate progress. The new CEO, once in office on March 31st, could refine or expand strategic priorities further. The company may also announce partnerships, software integrations, or loyalty initiatives as part of executing this digital agenda, but none of those were formally unveiled in the presentation itself. What this does not mean is just as important. It does not guarantee faster revenue growth. It does not signal an immediate cost-cutting wave. It does not represent a radical shift away from beverages. And appointing a chief digital officer does not automatically translate into instant consumer visible changes. It's a strategic emphasis, not a dramatic pivot. The bigger story here is continuity with sharper focus. Coca-Cola is preparing for a CEO transition and signaling that digital integration will be central to how it grows in 2026. The company is telling investors that data, innovation, and bottler alignment will work together to drive earnings. Whether that plan delivers measurable results will become clear in future quarters. For now, this is about direction. Coca-Cola has drawn a roadmap for its next chapter. The real test will be how effectively that roadmap turns strategy into numbers.